Welcome to the deep dive. Today, we're really digging into the Forex market, specifically the U.S. session outlook for July 4th, 2025. Now, I know what you might be thinking Forex on Independence Day,
Mm.
but yeah, global markets, they don't really take holidays, do they? Our source for this is really detailed. It's called the Meta Forex Analyst Intelligence Briefing. And our job, like always, is to sift through all that complexity. We want to pull out the key bits, the surprising facts, and give you clear insights on what's actually moving currencies right now. So why does this matter to you? Well, maybe you're prepping for a meeting or just need to catch up on global finance, or maybe you're just really curious how, big geopolitical stuff and economic numbers actually turn into market moves and, frankly, big money decisions. This deep dive is definitely for you.
Okay, let's try and unpack this global financial picture then. Even with the US market technically closed for the holiday, what's the main force really pushing currencies around right now?
Yeah, the main theme really is this pretty significant clash.
Yeah.
On one hand, you've got surprisingly strong U.S. economic numbers, but they're battling against some profound uncertainty coming from U.S. fiscal policy and, importantly, trade policy. So the core dynamic is a resilient U.S. job market, sure, but it's happening against this backdrop of, well, let's call it contentious government spending plans and these escalating trade fights. That's clouding everything.
That does sound like a bit of a paradox, doesn't it? We just got the June non-farm payrolls report, the NFP. What did that actually tell us, and why isn't that kind of headline strength boosting the U.S. dollar?
Right. Well, the NFT headline was strong, no doubt, came in at plus 147,000 jobs. That easily beat the consensus, which was around 110,000. But, and this is the key part, that strength is really dampened by cooling wage growth. Average hourly earnings, they only rose 0.2% month on month. The market expected 0.3%. So this slowdown in wage inflation, it actually suggests the pressure on the Fed from the labor market might be easing up.
Okay, so connecting the dots. Strong jobs, yes, but the wages are softer. Does that maybe signal to the Fed they have a bit more wiggle room? Maybe lean a bit more dovish, even with that strong headline. And looking beyond that data, which is kind of backward looking, right? Our sources are highlighting two big forward looking risks overshadowing things. What are those?
Exactly. Markets always look ahead. The first big risk is President Trump's proposed $3.3 trillion tax and spending bill. Analysts are warning this basically hardwires, quote, a steady fiscal deterioration.
Hmm.
The expectation is it'll balloon the national debt and, over the long run, likely devalue the dollar. That's weighing things down.
Right.
The second risk, and this one's much more immediate, is the July 9th tariff deadline. It's looming. President Trump has been very clear, no extension. He's threatening key partners like Japan with tariffs possibly as high as 35%. This constant uncertainty, it just throws a wet blanket on global growth hopes, makes central bank policy really tricky everywhere, and it pushes money towards traditional safe havens.
Okay, so that's the US picture. How are the other big economies and, crucially, their central banks reacting to all this pressure?
Well, we're definitely seeing a pretty critical split, a divergence in monetary policy. Let's start with the Fed, officially. They're sticking to this wait-and-see stance. Chairman Powell even mentioned the tariff uncertainty, specifically as a reason for holding off on rate cuts.
Mm.
But, and this is interesting, the futures markets, they're aggressively pricing in a rate cut at the July meeting. Very high probability. That seems fueled by some, pretty dovish comments from a few Fed governors. So the Fed feels caught. Intense political pressure pushing them to cut, but some data may be arguing to hold steady. Their current rate range is 4.25 to 4.5%.
Right. Okay. What about Europe? ECB.
The ECB, they've already started easing. They cut their main rate by 25 basis points back in June, down to 2.0%. Now, President Lagarde says she's committed to their 2% inflation goal,
Hmm.
but a new worry has popped up for them, the euro's strength recently. She actually noted it has a clear disinflationary effect. So that, plus some weaker data from places like Germany, it suggests the ECB might actually hit pause on more cuts. They don't want the euro getting too strong. Their rate's 2.0%.
Interesting. Okay, and Japan, the BoJ.
Japan's fascinating. There's a clear internal battle going on at the Bank of Japan. You've got the hawkish members pushing to restart rate hikes. They're pointing to surprisingly sticky domestic inflation.
Okay.
But then you have Governor Ueda, who's much more cautious. He's explicitly saying future policy moves depend on the real economic hit from U.S. trade actions. This division makes the yen incredibly sensitive to how these U.S.-Japan trade talks play out. Their rate is currently 0.5%.
Right. And just for context, the Bank of England is at 4.25%.
That's correct, 4.25%.
So with all these different central bank vibes and the geopolitical stuff, how's it actually shaking out in the currency markets right now? What are we seeing?
Well, the recent price action, it very clearly shows this dominant anti-dollar feeling. The U.S. dollar index, the USDX, is trading down near multi-year lows. And at the same time, you see USD pushing up, testing multi-year highs around that 1.1800 level. USD JPY, it's stuck in a range mostly, but there's definite persistent downward pressure there. Reflects that yen strength.
Okay, we've got the big macro picture, the central banks. But how does this translate into actual trades? Where's the smart money going? We need to look at the institutional players, right? Which brings us to the Commitment of Traders report, the COT data. What's that telling us?
Yeah, the COT report, this one's for the week ending June 27th, 2025, gives us some really critical clues about institutional positioning. Let's start with the U.S. dollar. The most striking thing is just how extremely bearish everyone seems to be. Net short positions held by the big players, large speculators, asset managers, they've jumped to a 5-year high. We're talking $21 billion net short. That is a very, very crowded trade.
Wow, 5-year high.
Yeah. And if you look at specific pairs, the anti-dollar bets are huge. Like 79% net short for USD JPY. Odd USD is even higher, 80% net short the dollar side.
Yeah.
USD CAD, 75% short the dollar. Even USD, it's 34% short the dollar side of that pair. It's broad-based.
Okay, so overwhelmingly bearish on the dollar. What about the other side of those trades? The euro, for example.
Right, good point. For the euro, it's the opposite story. Large speculators actually increased their net long bets by about 9,600 contracts. So 66% are net long euro ESD. That confirms a strong institutional consensus backing the euro's upward trend.
Makes sense. And the yen, you mentioned its strength.
Exceptionally high conviction there. Net long exposure in yen is holding steady at a really significant level, 132,300 contracts net long, big bet.
Okay. British pound?
The pound bullish feeling seems to be fading a bit there.
Yeah.
Net long position saw a pretty noticeable drop, down by 8,500 contracts. For GBP JPY, it's still 60% net long, but the trend is down.
Interesting. And the Aussie dollar, you said 80% short USD, so long AUD.
Sorry, that was 80% short IUUSD, meaning they are short the Aussie dollar against the US dollar. So bearish on the Aussie.
Ah, okay, got it. So 80% short AUD.
Yes, exactly. So net short exposure actually increased there, despite the Aussie dollar price recently moving higher. So a prevailing bearish institutional view.
A divergence. Okay. And the Canadian dollar?
Canadian dollar, the CAD. For the third week straight, traders who are betting against it, the bears, have been buying back their short positions, covering shorts. For USD CAD, only 25% are net long, which implies 75% are short at USD CAD, meaning they're long CAD. But the key is the short covering. That's often a sign that the recent bearish trend, the downtrend in USD CAD, might be running out of steam.
Okay, let's circle back to that US dollar point. A highly crowded trade, 5-year extreme short positions. That sounds like it could be a bit fragile, right? A potential risk for anyone still piling into that short dollar bet.
Absolutely. It raises a really important question, When almost everyone who might want to sell the dollar has already sold it,
Yeah.
well, there isn't much fresh money left to push it lower, is there?
Right.
This kind of setup is classic for a potential short squeeze. That's where you get a sudden, sharp, sometimes violent rally if some unexpected positive news for the dollar hits.
Like what kind of news?
Could be anything, really. A surprise breakthrough on trade talks before that July 9th deadline. Or maybe the Fed suddenly sounds much more hawkish than expected. It makes this a really critical risk factor to watch in the next few trading sessions. It really shows how layered these markets are. You think one thing's driving it, then boom, something else shifts the whole picture.
Yeah, absolutely. Okay, so our sources didn't just paint the big picture. They actually zeroed in on specific currency pairs they see as compelling opportunities. They used this sophisticated weighted scoring system looking at volatility, liquidity, sentiment, news flow to pick 5 key pairs.
Right. And this selection, this sort of curated portfolio, it gives exposure to 2 quite different potential scenarios, depending on how that tariff deadline plays out. You've got a pro-risk outcome, maybe a deal gets done, which would likely favor currencies like the Australian dollar, versus an anti-risk outcome, tariffs go on, triggering a flight to safety, which would probably benefit the Japanese yen.
Got it. Okay, first on the list, the big one, EURUSD, top pair for analysis. What's the deep dive telling us here? The projection is sideways to mildly bearish, targeting 1.1715 to 1.1810, confidence level 6 out of 10.
Okay, technically, EURUSD has been in a really strong uptrend for months. Powerful move. Right now, it's sort of consolidating near those multi-year highs we mentioned, but there are signs it's losing a bit of steam. The 4-hour chart looks indecisive, and the daily RSI, the relative strength index, is getting close to overbought territory. That often suggests a pullback might be due. Immediate resistance is that big psychological number, 1.1800. Support is down around 1.1715 to 1.1730. Our analysis flags that as a pretty significant area where institutions might be looking to buy.
Okay, that's the technical side. What about the fundamentals?
Fundamentally, it's a bit mixed, conflicted really. The current interest rate difference actually favors the US dollar, right? Fed's at 4.5%, ECB's at 2.0%.
True.
But the market, as we said, looks forward. It's focused on the future rate difference. And that's narrowing because traders are pricing in aggressive Fed cuts while the ECB might pause, as we discussed.
Yeah.
That forward-looking dynamic. That's fundamentally bullish for your USD. However, there's this growing counter-story from the ECB talking down the euro strength that could put a cap on how much higher it goes.
And the sentiment, the COT data.
Sentiment and positioning are extremely bullish euro. Remember, 66% net long by the big players, which again points to a crowded trade potentially vulnerable to a reversal. Our AI simulations, they suggest a high chance the pair stays stuck in that 1.1715 to 1.1860 range for now. But they also show an increased probability of a move back down towards that 1.1730 support area, mainly because momentum seems to be fading. Kind of a mean reversion idea.
Okay, interesting. Let's move to USD JPY. This one's right in the firing line of those U.S. tariff threats against Japan. The projection here is bearish, target 142.35 to 144.25, with a higher confidence, 8 out of 10.
Right. Technically, USD JPY is in a medium-term downtrend.
Yeah.
It's been chopping around in a wide range, though, roughly 142.35 up to 146.00. There was a bearish head and shoulders pattern spotted earlier, which usually signals more downside. Critical support is that bottom end of the range, 142.35 to 142.70.
And connecting that to the big picture.
The main fundamental driver is that narrowing rate differential we keep talking about. Fed expected to cut. BoJ may be hinting at hikes eventually. That's fundamentally bearish for USD JPY. It favors the yen. And then you layer on the looming U.S. tariff deadline. That's potentially a huge bearish catalyst. If tariffs hit Japan, the safe haven appeal of the yen would likely surge.
Okay. And the institutions?
Institutional conviction for yen strength is exceptionally high. That COT report showed a massive net long position in yen futures. Remember, 79% net short for USD JPY itself. That shows extreme institutional belief that this pair is headed lower. Our AI simulations. They give a significantly higher probability for a break below 142.35. They flag that level as a critical institutional demand zone. If it fails, you'd likely see a wave of stop-loss orders get triggered, which could really accelerate the downtrend.
That 142.35 level sounds absolutely critical then. If those tariffs do hit and it breaks, how much lower are we talking? What are the next levels people would watch?
Yeah, it's definitely the key level. If 142.35 breaks convincingly, it really opens the door to the 140.000 psychological level fairly quickly, and potentially quite a bit lower after that, just given how strong those fundamental drivers are. It's a major battleground right now.
Okay. Next up, GBP JPY, the pound-yen cross. Known for being volatile, and it's been in a strong uptrend. Is that trend sustainable? Projection here is for a bearish reversal, target 195.00 to 198.00, confidence 7 out of 10.
Yeah, GBP JPY is a wild ride sometimes. Technically, yes, strong uptrend, but some technical analysis, specifically Elliott wave theory, which looks for these recurring patterns. It suggests GBP JPY might be in the final leg up, the final impulsive wave of its current bullish cycle. That hints a correction, a move lower could be coming soon. It's also getting close to a big resistance level, the 200.00 cetological mark, and the daily RSI is nearing overbought again. So warning signs flashing technically. Critical support is down at 195.000. That lines up with the lower edge of its rising channel pattern.
Okay, fundamentals. The rate difference is huge there, isn't it? BoE versus BoJ.
It is. The wide gap between the Bank of England at 4.25% and the Bank of Japan at 0.5%. That makes a carry trade very attractive. Basically, borrowing yen cheap and investing in higher yielding sterling has been a major support. But again, looking forward, it gets more complicated. The BoE is signaling they'll probably ease gradually. The BoJ is hinting at hikes down the road. So that big rate differential could start to narrow. That, plus a sluggish UK economy, maybe some political uncertainty. Those are fundamental headwinds for the pair.
And the positioning. COT data.
This is probably the most important piece for GBP JPY right now. The COT report shows a major divergence. We saw waning bullish bets on the pound futures, remember?
Right.
But at the same time, you have that extreme bullish conviction in yen futures. We saw 60% net long GBP overall, but the trend in positioning is diverging strongly from the yen. This positioning clash is a powerful bearish flag. It suggests the big players are actually positioning for potential reversal, selling sterling and buying yen. Plus, the general risk-off mood ahead of the tariff deadline also favors a reversal, as a safe haven yen tends to strengthen in those times.
So, a really significant divergence in how the smart money is betting here suggests a strong trend might be about to turn, even though it looks strong on the surface.
Exactly. The smart money isn't just chasing the past trend, they seem to be anticipating a shift. It's a classic setup to watch.
Fascinating. Okay, let's look at OUD-USD, the Aussie dollar against the US dollar. It recently broke out of a 2-month sideways range, which usually signals more upside. Is this the start of a big rally or something else? Our projection. A bearish false breakout. Target 0.6500 to 0.6590, confidence 7.
Technically, yes. It clears the around 0.6550 pretty decisively.
Yeah.
Normally, that's bullish.
Right.
However, some analysts are pointing to a rising wedge pattern forming. Wedges like that can often act as bearish reversal signals, especially if the lower trend line breaks. Immediate resistance is just above 0.6590 to 0.6670. Support is back down at 0.6500, and the daily RSI. It's showing weaker momentum and maybe even some bearish divergence where the price makes a new high, but the RSI doesn't. That hints the upward push is losing conviction.
Okay. What about the fundamentals for the Aussies?
The fundamental outlook is actually largely bearish. The Reserve Bank of Australia, the RBA, is widely expected to cut interest rates at their next meeting, which is coming up on July 8th. Markets are pricing in multiple cuts this year, mainly because inflation data came in weaker than expected, so you have this dovish RBA contrasting with the Fed's uncertainty. That generally acts as a headwind for AUSD.
Okay, so fundamentals look bearish. What's the quantitative signal, the COT?
This is where it gets really interesting for AUSD. The critical quantitative data point is from the COT report. It shows a significant bearish institutional stance. Remember, large speculators actually increased their net short exposure, currently 80% net short AUSD.
Whoa, so price is going up, but institutions are selling more.
Exactly. It's a sharp divergence between price action and positioning. Strongly suggests that the smart money is actively selling into this rally. They might see it as a bull trap, making it look bullish to draw in the buyers, or maybe just a chance to get better prices for their short positions. A liquidity grab.
A bull trap.
Yeah. Our AI simulations show a high probability of another test of that 0.6660 resistance area. But if it fails to break through and hold above that level, the probability of a sharp reversal back down towards the 0.6500 support zone increases significantly.
So just to spell it out, the price chart might be screaming, buy me, but the big players are actually using that strength as an opportunity to get out or sell more. That's a huge potential aha moment for listeners, a real counterintuitive setup.
Precisely. It's a classic scenario where retail traders might get lured in by the apparent strength, while the larger institutions are taking the other side, using that inflow of buy orders to offload their positions or establish new shorts. Definitely one to watch closely.
Okay, last pair on the list, USD CAD. US dollar versus the Canadian dollar. This one's been falling sharply, an accelerating downtrend, and now it's grinding near critical support around its yearly lows. What's the potential future here? Projection is for a sideways to mildly bullish rebound. Target 1.3570 to 1.3660, confidence 8 out of 10.
All right, technically, USD CAD has dropped, over 1.6% just from its June high. It is testing that critical support zone near the yearly lows, roughly 1.3571 down to 1.3590. Now, the price is technically oversold. The 14-day RSI is below 40, which signals fresh bearish momentum, yes, but it also often suggests the move might be overdone and due for a bounce.
Okay, fundamentals for USD CAD. Bit of a mixed bag.
It is. The broad US dollar weakness we've discussed is obviously bearish for the pair, pushes it down. But counteracting that, you've got falling oil prices recently. Oil is a major Canadian export, so falling oil is usually a headwind for the Canadian dollar, which could support USD CAD.
Right, the loonie follows oil.
Exactly. And the pair is also caught up in potential US-Canada trade friction ahead of that tariff deadline. Another layer of complexity.
And the quantitative signal, the COT report.
This is probably the most telling signal for USD CAD right now. The COT report shows 3 straight weeks where traders who were short the Canadian dollar have been buying it back, short covering. Remember, 25% net long USD CAD implies they were covering CAD shorts. This is a classic sign that a downtrend might be reaching exhaustion. It becomes vulnerable to a reversal as the big players lock in profits from the successful downward move and reduce their exposure.
So they're taking money off the table on the short CAD trade.
Seems like it. Our AI simulations, They show a high probability the pair test at 1.3571 down to maybe 1.3540 support zone, but they also indicate a significant chance of a mean reversion bounce from that area. Given how fast it's fallen, the oversold condition, and maybe supportive fundamentals like lower oil prices, a bounce looks quite possible.
So really interestingly, despite this accelerating downtrend we're seeing right now, the analysis suggests we could be looking at a pretty decent rebound opportunity here, almost betting against the immediate momentum.
Precisely. It's a setup that often catches people off guard, but frequently signals that a strong counter-trend move could be brewing. Definitely one where the immediate price action might be misleading.
Wow. That was an incredible journey through all the moving parts of the Forex market. Let's try and bring it all together for everyone listening. What's the absolute core message from this deep dive for you, the listener?
Okay, the main takeaway is that the Forex market is entering this July 4th U.S. session period in a state of really high tension. The dominant theme, overwhelmingly, is profound U.S. dollar weakness. The dollar index is near multi-year lows. And crucially, speculative positioning is at that 5-year extreme net short level, $21 billion. This is a classic crowded trade, and that carries a significant risk of a short squeeze as a sudden dollar rally, especially with that July 9th tariff deadline acting as a huge potential trigger, a binary event. Our analysis, looking at all the layers, suggests major currency pairs are sitting at critical turning points, inflection points. USD JPY, strong bearish conviction, likely to test lower levels. GBP JPY and EGO USD, they look ripe for reversals or maybe false breakouts. Those divergences in institutional positioning are key signals there.
The bull trap idea for AUD USD.
Exactly. USD CAD looks poised for a rebound, bouncing off technically oversold conditions and that short covering signal, and your SED. Despite its strong uptrend, it's showing signs of getting tired, maybe due for a corrective pause or pullback.
So the key takeaway for you listening is really clear, isn't it? Understanding all these layers, the global macro stuff, what central banks are signaling, and especially how the big institutional money is actually positioned, it gives you such a richer perspective than just reading the headlines.
Absolutely. It helps you understand not just what's happening, but why it's happening, and maybe get a sense of what could come next for the global economy and these markets.
What a fascinating deep dive, how all these global events, central bank moves, and where the big money is flowing all collide in the currency markets. It really is a complex puzzle, so many moving pieces.
It truly is. And, understanding these layers, as you said, it helps make sense of it all. It gives context to the noise and helps anticipate potential shifts.
And for you, our listener, here's maybe one final provocative thought to chew on. Given that extreme short positioning on the US dollar and this looming tariff deadline, how much do you think expected events really move markets anymore compared to the raw power of surprise? Something to think about. Thanks so much for joining us on this deep dive. We really hope it's given you a clearer, more informed view on all the forces at play right now. Stay curious, and we'll see you on the next deep dive.